Imagine waking up to find that one of your investments just rewrote your entire financial future. That's exactly what Palantir did today. We're not talking about a modest 5% uptick or some slow climb over the quarter. This stock just obliterated its previous record, pushing into territory that few expected so soon. For those who've been holding on, it's a moment of validation. For those still on the sidelines or thinking about buying in, it's time for a serious conversation. Let's break it down: numbers, expectations, strategy, and most importantly, what should you do next? Welcome to Stock Hub, your go-to place for the latest stock market news, analysis, and insights. Let's dive in. Today marks a milestone in Palantir's journey. The stock just shattered its previous all-time high. Where it once peaked around $125 per share, today it surged as high as $130.49 during intraday trading and ended the session at a new closing high of $128.10. As I'm creating this, it's nudged up even further in after-hours trading, currently sitting at around $128.26. To put that into perspective, Palantir has gained over 18% in just the past 5 days. That's the kind of return that investors usually hope to see over an entire year. And that's not the only number that'll blow your mind. In the last 30 days alone, Palantir has delivered a return of approximately 45.6%. Over 6 months, a staggering 109.8%. And in the past 12 months, the stock has climbed by a jaw-dropping 521%. That's not a typo. That's 521% in a single year. Since its debut, the total return sits around 180%. But if you were among those who bought in when it dipped to its lowest levels, you're sitting on gains that exceed 1,000%. My personal cost basis? $8.12 per share. At today's price, that means my return is a mind-bending 1,477.8%. This isn't just a win. It's a complete game changer for my portfolio. But let's take a moment to step back from the excitement and talk strategy, because many of you watching are wondering the same thing. Should I buy more? Should I sell? Or just sit tight? First, let me speak directly to those thinking about buying more shares right now. Here's the honest truth. Palantir is not a short-term play anymore. If you're the kind of investor who's thinking in terms of 1 to 2 years, this might not be your moment. Yes, the stock is hot right now, but the valuation is also stretched, and I mean really stretched. While I'm not flashing any red warning lights, I do think we could be heading into a phase of sideways movement, what we call being range-bound, where Palantir might trade between $120 to $130 for an extended period. Why? Because at some point, no matter how exciting a company is, institutional investors and retail traders alike begin to hesitate if the valuation gets too ahead of the fundamentals. And that's exactly where we are. While I can't show you the numbers on screen, the PE ratio and price-to-sales ratio are both elevated. Not unexpected for a growth company, but still something to take seriously. Now let's be real. Palantir is not a stagnant business. This is a rapidly growing company that's expanding its revenue, improving operational income, and increasing earnings per share. Over time, if the stock stays relatively flat, the fundamentals can catch up to the current price. That's a good thing. It gives long-term investors a solid foundation. But if your timeline is just a couple of years, that sideways movement could feel frustrating. So who should be buying Palantir now? In my opinion, only those who are committed to holding for 10 years or more. If this is a company you believe in and want as a long-term pillar in your portfolio, then yes. Even at these levels, it might still make sense. But for short to mid-term holders, I think there's better value elsewhere in the market right now. Stocks with more room to run based on both fundamentals and valuation. Now let's talk about the flip side, selling. Maybe you're holding a large Palantir position and are wondering if now is the time to cash out. This is where it gets a little more personal and strategic. One important factor to consider is capital gains tax. If you sell now, depending on how long you've held the shares and what tax bracket you fall into, a significant chunk of your profit may be going to the IRS. Long-term gains are more favorable than short-term, but they still sting. If you've got, say, $100,000 in profit, you'll need to set aside a portion for taxes. and that's not something to overlook. Now, here's a strategy that's worked well for me. If you're sitting on a 10x return or even more, consider pulling out just your initial investment. Let's say you originally put $100,000 into Palantir and it has ballooned into a $1 million position. You could take out your original $100K, leaving the $900,000 in profit to continue riding the wave. That gives you peace of mind. You've secured your original capital, while still staying exposed to future upside. It also takes some of the emotion out of the equation. When the stock drops 10 or 15% on a bad week, you're less likely to panic because you're essentially playing with house money. That's what I did. I pulled out my principal and diversified it into other high-quality stocks with strong fundamentals and better short to mid-term value. Now, no matter what Palantir does in the short term, I'm unfazed. Whether it dips 5% or surges 20%, I've already taken a win and repositioned for the future. The emotional side of investing is real, especially when you're deeply connected to a winning stock. But part of being a mature investor is learning to detach emotionally and make clear-headed decisions. Selling your principal while letting your profits ride can help you do that. It's about striking a balance, preserving gains while maintaining potential. Thanks for watching Stock Hub. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon so you never miss an update. See you in the next one.